Hello there again. This is Unit 3. We're going to start talking about the balance sheet and using it for analyzation here. And this will be the first segment video, trying keeping things in that 10 to 15 minute range for our videos. So let's get to our content here. As we talk about this section, the objectives that we're going to have, you can read through them. I'm not going to spend time on the video reviewing all of them, but we're going to have several things that we want to accomplish when talking about the balance sheet. So just to get us familiar with what we're talking about, specifically the balance sheet, and then comparing it to an income statement that we will cover, I believe, in the next unit. Balance sheets summarize your financial condition at one specific point in time, and then also estimates the net worth or your equity in your business by valuing the assets against your liabilities. Again, this is a single snapshot in time. So we could do a balance sheet today and then go sell a bunch of grain and cash a bunch of checks and, maybe sell some cattle. And tomorrow our balance sheet would look quite a bit different. So it's important to recognize what a balance sheet actually does. An income statement summarizes financial transactions that have affected revenue or expense over a period of time and gives you a much better estimate of net farm income or actual profit. A balance sheet really doesn't do that. It only gives you a picture of profitability and a few other markers that we're going to look at later. So what do we do with a balance sheet? What is its purpose? Basically, it's a systematic organization of everything owned versus what we owe. So an asset, of course, is anything of value owned by the business, and a liability then is any debt or financial obligation that the business has. So it's important, we're going to categorize everything that the farm business or agribusiness has into those two sections. So for a balance sheet to be in balance, the assets then equal the liabilities plus the owner equity. So just kind of keep that in mind whenever we get to actually calculating these in class. A balance sheet can be done anytime during an accounting period. If you just wanted to check your net worth, you could do it any day. But it's going to be very helpful whenever you talk about applying for loans. If you're doing an operating note, your lender's probably going to expect a balance sheet. If you want to buy a new piece of land on a mortgage, your lender is definitely going to request a balance sheet. But most are prepared at the end of an accounting period, at the end of your calendar or fiscal year, and then kept in file because you can compare 1 year to the prior year or one balance sheet to the prior balance sheet as you see trends in net worth develop. That's kind of how they're useful in another way. So how do we utilize these kinds of things? So we're going to get to some really critical terms here and some metrics that are important about balance sheets. Again, we're going to measure your financial position with two different concepts. Number one is solvency. So we're measuring your liabilities of the business relative to the amount of owner equity invested. So it indicates your ability to pay off all financial obligations if all of the assets had to be sold. Do you have enough money in the bank or enough value in your assets to meet all your financial obligations? If you do, then your business is solvent. If you don't, you're at risk for bankruptcy, and what we would then categorize your business as insolvent. So that's a really key measuring stick that we can get off of a balance sheet to assess your financial condition. Second is liquidity. So it measures the ability of the business to meet financial obligations as they come due without disrupting normal flow of operations. So as seed bills or as fertilizer bills come due, do you have the money? Do you have enough liquid assets, whether it's cash on hand or maybe grain to sell, in order to meet those financial obligations? Can you generate enough cash at the appropriate time? And again, typically we're going to measure liquidity over whatever the accounting period that we select is. Two really critical metrics to get here. So let's look at a balance sheet format. On one side of the ledger, you're going to have assets. So these things have value for one or both or two reasons. They can be sold to generate cash or can be used to produce goods sold for cash. So, of course, grain in the bin could be sold to generate cash. That asset has value. Also, your planter that sits in the shed. It's utilized to produce goods sold for cash. That has a value. And so you put that on the asset side of the ledger. We can break these down further into liquid assets, things that can be sold without disrupting future production activities. So feeder cattle could be sold to generate cash. It's not going to disrupt what you do. Grain in the bin, you could load up the semi and head to town and sell it and get some cash. It's not going to affect your normal operations. That's why we call those liquid assets. But we also have illiquid assets. I mentioned that planter. You could sell the planter and generate cash, but it's going to disrupt your normal flow of business when planting has to be done. And then you would have to come up with another planter or a way to get things done. That's what we call an illiquid asset. So it's much more difficult to sell at full market value quickly, or it's definitely going to interrupt the normal flow of business. So those are illiquid assets. So you can break those down even further. We'll also look at current assets. So things that are more liquid and more easily sold, like grain or livestock. Cash in hand is obviously a current asset. Feed that's in the bin at home, that's a current asset. And also non-current assets like your machinery, your buildings, your equipment. All of those are longer term assets and categorized as such. So that completes one side of the ledger. On the right side of the balance sheet ledger is your liabilities. Those are your obligations or debts owed to someone else, accounts payable, so to speak, especially on the top right-hand side of the ledger. And we'll look at an example here in a little bit. So you can look at current liabilities. So a financial obligation that's going to come due or payable within 1 year of the balance sheet that you are building. So it's going to require cash to meet that need. So example, maybe you run an account at the local farm supply store, and once a month or once a quarter you go in and pay off all of the feed or supplies that you've purchased on a regular basis. That's a current liability. So you would also include any principal payments due within the year. So if you have a mortgage, there's principal due every payment. You count that as a current liability. Also, accrued expense, interest and property taxes, those are also accrued expenses that are a current liability. We would also then separate non-current liabilities. So all financial obligations that do not have to be paid within the next year. So if you have a mortgage and you make the principal and interest payment that's due this year, the remaining principal and balance on the loan actually goes in the non-current liabilities section. That would be money that is due later, but you still owe it. So it's important to account for it. So then we get into some of the answers, so to speak, of the balance sheet, and that's owner equity or net worth. The amount of money left over if everything was sold and all of your bills were paid, how much money would be left over? And that's your net worth, and kind of the balancing figure at the end of the balance sheet. That number is very often fluid, but changes for a number of reasons. So sometimes the utilization of assets to produce crops, or we purchase additional assets. We go out and buy a piece of land. We have that land as value, but we also maybe now have a new mortgage payment. So there's a number of different things that could change your balance sheet picture. Maybe you have a change in the asset value. Maybe we withdrew some cash from the farm business checking account and put it in a different account. Or maybe we deposited some cash into the farm business account. So there's a number of different reasons why equity changes, but we can generally summarize them into three. We add personal capital to the business, we withdraw personal capital to the business, and the business shows profit or loss. So generally, that's what makes the balance sheet move one way or the other. Of course, there's some alternatives when we talk about building the actual balance sheet. We can break assets and liabilities into current and then intermediate and fixed, or current, intermediate, and long-term. And the slide here gives you a little bit of definition of the lifespan of each of those and what might help you further subdivide them. I actually like this format quite a bit because it separates things out kind of very much more connected to what you would use on the depreciation schedule that we just talked about in the prior unit. So here's an example of a general format. So we have current assets of $100 and non-current assets of $400 in value. So a total asset on the left-hand side of the ledger of $500. On the right-hand side of the balance sheet, we owe somebody $60, and then we also maybe have a loan value out there of $200 liability yet that's non-current, so it's not due within the next year. So a total liability of $260. So if we subtract 500, if we subtract 260 from $500, our owner equity is $240, or our net worth. If you do the 3-category system, basically, again, all that we're doing is adding that intermediate term row in there in terms of those things that have a lifespan of more than 1 year, but likely less than 10. So again, you can come up with the same amount on your balance sheet, just broken out a little bit more specifically. When we value your assets, of course, there's a number of different ways to put a value on an asset that you have. First thing you could do is do a cost basis balance sheet. So, when we follow accounting principles, you should value your assets using its cost, or cost less depreciation, or your farm production cost methods. So what does it cost you? That combine that you bought that's now an asset on their farm, what did it cost you? Not necessarily what its market value is, because those can be two different numbers. Or when you're putting together your balance sheet, that pickup truck that you bought, how much did it cost you, or cost minus its depreciated amount, so it's depreciated value, not necessarily its market value if you put a sign in it and put it in the yard for sale. Exceptions might be grain inventory, because the value at market might be less than the selling cost under normal conditions, or market livestock could be very different. Of course, then you could also do what we call a market-based balance sheet. So all assets are valued at market value less the selling cost. So long-run inflation could cause land to actually be more valuable than its cost. So maybe you bought a piece of land for $5,000 an acre, but appreciated over time. Now it's worth $8,500. That moves your balance sheet obviously in a much different direction than if you just put $5,000 an acre on. So often it shows more total value in equity than the cost valuation that we looked at in the prior slide. So what are the advantages of a cost-based balance sheet? So it conforms with accepted accounting practices. An accountant appreciates that a lot more. And it probably is more likely to be comparable with other business balance sheets if you want to compare your farm's balance sheet to other farm balance sheets. That's a more fair comparison. So changes in equity only come from net income increase, not from change in asset value. So you're kind of narrowing it down as why your net worth changes. But what is market-based balance? What's their role? A market-based balance sheet. It might actually be a better indicator of your current financial condition or your current net worth. The value of collateral to obtain loans is a little bit closer. And obviously here's a endorsement that suggests it occasionally. So it's important to know when to use a cost basis versus a market basis balance sheet. And if you're confused, talk with your lender or your financial advisor in knowing which one is more appropriate and which one they prefer. So here, if we look at just a crosswalk of asset valuation, marketable securities might be cost basis, or market basis. And you can go on down through and look at each one of those differently. Here's a good example of a balance sheet, and it might look confusing, but it's important to look at one. We have basically two competing balance sheets on the same table here. You have a cost basis versus a market basis balance sheet. So if you go down through here are your current assets, and we would value those at $111,300. If you actually put market value on, and if we scroll up here through here, the different is the marketable securities, so like an investment account. You have a little bit different asset value in current assets. Non-current assets down at the bottom, we obviously have quite a bit different number down here at the bottom. So non-current assets on the cost basis, $442,000, market value basis, $629,000. The difference is land is one of the main big differences in building and improvements. Huge differences in what they would maybe be purchased for So maybe that land cost you $288,000, but in today's market value, it's worth $400,000. So almost a $200,000 difference in asset value on the assets side of the ledger. Liabilities, again, doing the same thing, cost versus market of the liabilities. If you scroll down through here and look, we find about a $200 difference in deferred taxes. If you look at the non-current liabilities, notes payable, we see about a $50,000 difference in market versus cost value, and most of that comes from deferred taxation again. So what's the bottom line? Well, your equity position, when you get down here at the bottom, total equity, on a cost basis, your net worth is about $230,000. On a market basis, it's $372,000 and change. So it's a lot different position when you talk about doing financial analysis. One is, both are accurate. It just depends on which way your lender or your financial advisor wants to see it. So that's going to wrap up segment 1 in Unit 3 here. Try and keep these short so you can watch them in short order, take notes, and then we'll be recording segment 2 soon. Thanks for listening.